very much for joining us. And how's it going?
Thank you, Govind. It's a great pleasure to be here and to be talking to your audience. And I hope they find our conversation interesting.
Right. So let me start, before we dive into what you do and how you do it, let me ask you a question that must be on the minds of some investors in India, if not many. Would your model have predicted a Paytm falling 27% on its listing debut?
No, I don't think it would have. It would also not have predicted Nika zooming after its debut. That's not what we do. I think we are more on fundamentals, technicals, and we predict slightly longer term patterns. So we need a lot more information once a company goes public before we can make any predictions.
Right. And that's really my question, Akshay. So, here is a classic case where you do not have enough data to start with, and therefore you need data, you need history, and that's how your model can start working, or any model can start working and deriving intelligence in terms of insights and so on. So tell us about how Bridgeweave works and how InvestorAI specifically works when you look at the vast universe of stocks today.
So, Govind, let me take a step back. And what is the mission behind InvestorAI? Our goal is to really allow every investor in the world make a more informed investment decision. We're not the magic wand. We won't make you millions of dollars overnight. That's not what we do. But what we have found is if you're a hedge fund manager, you have an army of quant analysts who are doing your bidding and analyzing things and giving you ideas. But if you're an individual investor, then there's nothing for you. At one end, you have Yahoo Finance and Google Finance, at the other, which give you a lot of information, but almost too much information. At the other end, you have Bloomberg, which is $10,000 a year and very hard to understand. So if I'm a retail investor, which I am, where do I go for sensible information that filters out the noise, gives me something that I can act on? And that's really why we created InvestorAI. And then we said that, look, we can teach the machine to recognize breakout patterns. So we have used 14 years of data across 18 equity markets to train our algorithms. So, and to identify breakout patterns. And whenever we now see a breakout pattern, that's an investment idea that is a candidate to be published on our app. And then goes through a few set of controls before it actually goes out. So we take in 900 pieces of information on every single stock that we cover, which is about 4,600 stocks. We perform about 800 million computations every morning before we release the app for the day. And then we show it to you in a way that you can understand. And that's really what we do.
Right. So tell us about, if I was an investor today and I were to obviously, let's say, download your app, what is happening on the back end, and that is going to tell me what I could do or what I should do as in my journey as an investor, and what are the kind of signals that are likely to come which I will not get elsewhere, or I could not, let's say, deduce from my own reasoning by either looking at Google Finance or Yahoo Finance.
Yeah. So first, so you have to teach the AI, and we have taught the AI to identify stocks where there are breakout patterns or unusual activity that could lead to something. But we generate like 500. If you go to the app, there are 500-600 ideas at any point in time. That is too much for any single person. So the app needs to learn about you. And the more you use the app, the more it learns about you, your interests, what you like today versus what you liked a week ago. And then it begins. So you have to, so it learns about the markets you like. It learns about the sectors you like, learns about the kind of stocks you like. And then it starts to show you ideas that it thinks may be of interest to you. The learning process itself is a little bit like, what self-driving cars use for image recognition. So when you see something that's 14 inches high, has 4 legs and a tail, chances are it's a dog or a cat. Now, it doesn't matter whether it is a dog or a cat, but it is a live obstacle that you need to know. Similarly, we perform all these analytics and we convert them into grayscale images. And then we use these images to identify images in today's data. And it's a very fast process. And, like facial recognition, the more dogs the machine sees, the better it gets to in recognizing dogs or cats or any humans. And similarly, the more images that the machine sees, which it sees every day, it gets better at identifying them. So our algorithms tend to be quite high accuracy predictions. No, nothing is 100%. And market volatility, of course, affects the accuracy. But it is better than what you could do yourself, because no matter how diligent you are, you cannot look at 4,000 stocks every day. Even if you say, I'm not interested in anything other than India, then there are at least 300 stocks in India that you should be interested in. No human can do equal amount of analysis every single day of the week. It's not possible. And that's where the machine comes in. And that is why the combination of human and machine is really what produces magic.
Right. So here's a question which is on the way AI works in general and in specific in this context. So you are obviously looking at historical data and that's all you have, but you're also trying to bring in an element of predictiveness. How does that work in this, which is your case of market information or stock data? And how does AI work in general when it comes to predictive from your understanding?
So let me answer the second part first. So AI models are intended to be predictive. Not always predictive in nature of outcome, sometimes the nature of the next best action. If you see a patient who's got a cough, and he's got temperature and stuff, chances are this is, he's got flu. That therefore this is the treatment. In our context, we are doing something. Well, I don't know if it's different. I mean, let me take a very different example. For centuries, we've had arranged marriages in India. So if I have a daughter, for instance, who I want to get married, and that's many years ago, I would look for a boy, and what would I look for in the groom? He's had good education, he's had a good job, he comes from a good family, he's reasonably well off, there are no character flaws, etc. So all these are features that, you put them together, they will indicate chances of a good match. I think we are trying to do the same thing. We look at stocks, we look at performance, we look at 900 different variables, and then we say, if this is the combination that is there, history suggests that there may be a positive outcome or an alpha return in this. So we use exactly the same logic to make predictions. I mean, humans have been doing it for centuries. We call it judgment, because sometimes we call it predictions, and sometimes, it is really our best judgment based on available facts. Now, in the context of the machine, it can look through a vast array of available facts, much more than any person can. It can recognize when it has made, these patterns have led to a positive outcome, and then it learns from mistakes. So it's quite a powerful proposition.
Right. So, two questions. So, you talked about breakouts. So, if you could tell us a little more, for particularly those who are technically oriented in our audience today, about how that works and how does the code or the algorithms themselves, how do they track, and what do they look at as exceptions or not, and how do they then create the base level of let's say data points on a certain stock? That's one part. The second part is, as you look ahead, how do you, obviously the way this becomes accessible to a person like me is because you have scale. And if the same data is available to everyone, or the same insights are available to everyone, then does it still retain the same level of attraction or attractiveness?
Yeah, both very good questions. So let me answer the first one with an example. So one of our algorithms you will find on our app is called Alpha 330. And the reason it is named such is because it looks for stocks that have an opportunity to generate 3% alpha over the next 30 days. So it's really a 30-day algorithm. Now, our models have shown us that if certain conditions exist in a stock, then the probability of it delivering a 3% return in the next 30 days is very high. That is how we have trained the algorithm. I won't go into exact features because that's a little proprietary. And besides, there are many, many features. So the moment the algorithm, so we actually run this calculation for every stock in our universe every day. Wherever we see a high probability, it is then a candidate for, for the shortlist. And then we go through a few other controls. We check for a few things, and once it passes those controls, then we publish it. So, when now you could buy it immediately at the point it is published. You could wait 3 days, but in 3 days the stock may have moved. Not everybody acts at the same time on the same idea. That is one thing that creates a difference. The second thing that creates a difference, I could be interested in energy and technology. You could be interested in pharma and healthcare. So not everybody looks at every stock every day. If everybody was looking at it every day and theoretically making the same decisions, yes, then you'd have a second order effect of the prices moving because of the idea itself rather than anything else. But I think that's a reasonably far thing. Now, I hesitate a little before I say that because what happened in GameStop was exactly what you were saying. Some people said that, let's go after the stock. Then everybody got after it. Then everybody read Reddit. And all of a sudden, GameStop went up 300% in a day. So it can happen. But I think it's very unlikely for this to happen on a sustained level.
Right. So if as you take offerings like this to larger audiences or retail customers, how do you create differentiation, or rather, how do you create algorithmic differentiation? Is it that the algorithms themselves obviously have a gradation of sorts? There are complex algorithms offering you complex insights or more sophisticated insights versus not so complicated algorithms which offer you simple insights, or is it a mix of both?
Okay, so what we have something that we call a knowledge fabric, and that is really the overlay layer that sits on top of an algorithm. So I could say to the algorithm that don't consider a stock undervalued unless it is below the 20th percentile of its 10-year trading history relative to the index. Now, you could say that no, 20th percentile is not right. I want 15th percentile. You could say that I could say a good stock is when I compare it to the sector, it ranks above 70th percentile. You could say, no, I want something above the 85th percentile. So these are rules that you place on top of the signals that the algo is generating. What we find, so we are in conversations with a European broker. I won't name them because they're very well known. And they're saying that we only cover X number of stocks. So you cannot give us signals and ideas on any stock that we don't cover, therefore our customers can't buy. So in every instance, Govind, when we make our algorithms available to partners, there is always a knowledge fabric that goes on top that customizes the output for the firm we are dealing with. So you could be a wealth management bank and say, my approved list of stocks is only 200 stocks in the US. So that is all I want to see. There are Indian banks who say that our approved list of mutual funds is 170 mutual funds. We don't want more than 10% in any single fund. We don't want more than 20% to any single fund house. So there are all kinds of customized rules that come into place. And they actually make the output very different.
Right, and that's interesting because and you tied up with IIFL Securities in India recently, and I'm assuming they have a certain basket need for their clients and how they want to present it. But and let me ask you then a question that again goes back to the start point. So when you create an algorithmic framework for something like this, there is obviously some human element input going in, which is to say that I would like to focus on X number of stocks, but stocks which have behaved in a certain way over a certain period of time, I think that these breakout patterns are important because these are breakout patterns, or in my understanding, and therefore you train the algorithm in that way. So how do you ensure, now this is a specific and a general question, how do you ensure that the bias here is kept to the minimum, or how do you keep, let's say, eliminating bias even in an evolutionary way?
So that's an extraordinarily good question. We found that the algorithms are the algorithm. They will generate all the signals you tell it to generate. But what is a breakout signal? Is it 3%? Is it 2.5% in 30 days? Is it 1% in a week? So all these are factors that you have to overlay. What we have done is based on early customer research, a little bit of our own judgment, etc. What we like to do is be very transparent about what the rules are. So it is 3% in 30 days. Now you could say that, that is not big enough. I need 6% in 20 days or whatever. We have a value investing algorithm where undervaluation is the 20th percentile. People could come and say, no, I think if less than, it has to be less than 10 or something like that. So those are matters of judgment that you can challenge. The way we have built the algorithm, that it is configurable. Now in Investor AI, you get one version of it. And that's in the app that's available to everybody. But if you wanted to change some of these parameters, they are parameters. They can be changed. And the logic here is that I want what happens is if you change these parameters, the predictive accuracy changes. So if I say I only want to look at stocks that have fallen below the 10th percentile of the trading history, then the prediction accuracy is a certain level. If I say 20th percentile, it's at a certain level. So we actually run many models concurrently for one algo, and we see where we are getting the best accuracy. So that is one factor that we look at. The second factor we look at is that the same parameters don't work in every market condition. So as the market conditions change, we have to look at slightly different versions of the model. And what we have found that the models work best when the market is either trending up or trending down. It is the turn moment that is the trickiest, when the market is beginning to turn. And that has been our experience and learning from having done this for the last 2 years.
Right. And there is obviously evolution happening all the time. There was earlier a presentation by Sanjeev Sharma, the founder of Swayat Robots, and they're actually trying to create autonomous driving solutions for Indian roads. And if you see some of the images, they even account for cows crossing the road, potholes, and all kind of many of the aberrations that you would typically see on a non-highway Indian road. So that's one kind of learning. In your world, I'm asking, could it be that, for instance, you have a new generation of investors whose expectations are quite different? Let's say, and more specifically, it could be in the way the kind of IPO rush we're seeing in India today, or the frenzy that we are seeing in crypto, where expectations are quite wild and quite removed from someone like you and me. So how do algorithms grow and quickly account for these things, or is there any kind of, let's say, judgment call that comes in?
So there are many questions in that statement, Govind. Let me pick up the point about the digital generation of investors. I think something wonderful is happening in the world. If I take the pandemic period, India added about 18 million new customers. US added about 10 million, UK added about 3 million, and it's happened around the world. So it's not one country phenomenon. The interesting thing for me, and especially having spent years in wealth management, that these customers did not go to wealth management firms. They didn't go to UBS. They didn't go to JP Morgan Wealth Management. They didn't go to IIFL Wealth Management. They went to brokerage houses. They went to IIFL Securities. They went to Zerodha. They went to Paytm Money. They went to, they went to Robinhood. They went to Free Trade in UK, Hargreaves Lansdowne. What this is telling me is that there is a generation of investors coming who don't want the old traditional wealth model. They don't want advice. They don't trust banks and institutions. They trust each other. They don't want to pay high fees. They want ultra low cost. They don't want to be denied access from sophisticated products. They want access to everything, futures, options, derivatives, etc., etc. And they are very hungry to learn. And I say this with the first-hand knowledge because I conduct a weekly webinar for our customers, and I'm seeing such a hunger for learning. I think this is a transformational trend in the world, and we will see the impact 10, 15 years out. So I don't know if I've answered all your questions.
Right. saying that essentially this, so therefore, what you're saying is that we have to, or your algorithms have to learn what this new breed wants and has to respond to their needs and their tastes.
I'm actually saying more. I'm a little more than that. I'm saying that this generation will want products and services that do not exist today. They will want 100% digital journey. They will want it on their mobile. They will want it to be extremely low cost, if not free. And they will want self-service. They don't want somebody else walking them through it, or doing it for them. These
Right.
products don't exist. The only way they can exist is through AI and algorithms and technology. So, so some of this stuff exists. We as a company are very focused on this. That's what we are trying to do. But there is a lot more to be done. You talked about self-driving cars and bots in robotics in India. I think there's a huge place for robotics in investments, because sometimes I don't have the time to look at investments all the time. If I could train a bot to do what I want, that would be beautiful.
Right. And do your algorithms, for instance, when faced with a situation like this, which is a highly evolutionary marketplace where new kinds of investors are coming with different needs and radically different perhaps with the past, do algorithms learn from the investors themselves, or do they learn from the creators of the algorithm, or how does it work on the back end?
So in our case, InvestorAI, we learn from user behavior. So we learn from what the user is telling us when he sets up his account. So what we call disclosed information. Then we learn from what we see the user doing on the app. So that what we call observed information. And based on that, we make inferences about user priorities and behavior. And let me elaborate a little on that to explain how interesting it gets. You're a customer of wealth management company. If all of us are. When you first start the relationship, they'll come and ask you some 20 questions, and they'll say, "Sir, you are medium risk profile, and therefore this is the portfolio you should have." It's a once a year exercise, and then it gets filed, and no one looks at it ever again. I think in reality, I may be medium risk on Monday, but I may be high risk on Friday and low risk the following week, based on what has happened in my life. My thinking, my risk appetite, my desire to invest changes day by day depending on my experience. You have to profile in real time, otherwise, you don't know what the customers are doing. The only way to profile in real time is to use technologies like AI, and then that makes it very personalized and therefore a very engaging experience.
Right. And yeah, I can imagine why your system is doing 800 million computations every morning before sort of kicking off as the market start. So tell us about some insights that you've got. I mean, what is your, your ability to harness the data that you have? What has that told you, particularly, let's say, for our Indian audiences, about the way people are buying or investing in the markets at this point? And which also gives you a sense, which also, if possible, gives us an insight on how the power of AI is being used in this context.
I am seeing, and I speak from our user experience plus what I hear on our weekly webinars. I see two dominant age groups emerging, and they're slightly different in how they behave. One is over 50, and the second is under 30. It's between 30 and 50 where we don't see much. I guess that's when you have children, mortgages, home loans, and all the rest of it. The under 30s is very, very hungry to learn. They don't have a lot of money, but they are very much, their appetite for loss is much higher than over 50. So they are willing to take risk, they are willing to learn, and they're willing to invest in that learning. And I think that's a very heartening trend. The over 50s are, I would not say more conservative, but much more data driven. They are equally digital. In fact, I was reading an article somewhere that the most digital customer is the over 65, because he or she has seen what it was like to be not digital and what it is like to be digital, and therefore prefers, the younger customer has never seen anything else, so they just go on with whatever it is. It's an interesting idea. But coming back to this, uniformly, I see that people, whether they are in the first cohort or the second cohort, appreciate the data and a data-based, data-driven approach to investment, rather than here is a tip and go buy the stock or something like that. So this inclination to look for data is very heartening to me, and I think that is the right way for an investor to approach investments.
Right. Last question. This is about AI for good. So, what does AI for good mean for you, and the way you will be using AI in coming months and years at Bridgeweave? And what could I, as a consumer, for example, expect or benefit from?
So we think of AI in three ways. One is it must have a positive impact. So if I mean, we don't give investment advice, but at the end of the day, if my customers are not making money, then I have a useless product. So impact, the outcome for the customer is the first thing. The second thing is that it must be low cost. You cannot use fancy technology to charge more money. In fact, you have to drive the cost down. And so democratization is a very big element in our thinking. And just recently, this week, we have actually made our app free. We initially were charging and not giving a lot for unless you paid some money. So we have made it now. You can go in there and get everything except any insight that's 2 days old. For that, you have to pay a little bit of money, but the rest of the thing is completely free. And finally, which is, I will tell you, it's harder than it sounds, is explainability. I want to be able to explain to people why the machine thinks this is a good idea. And we have made early strides, but I will tell you, this is the one I'm most unsatisfied with, because we are doing it. We are doing it much better than many other people I know, but it is still not to a level where I can say yes, I'm satisfied. So this is a journey that will continue.
Right, Akshay Bhargava, we've run out of time. Thank you so much for joining me and taking us through Bridgeweave's advances in the space of AI. So, if someone wants to visit your website or play around with what you have, where should they go?
They should go to the App Store or the Play Store, look for Investor AI, one word, and just download and have fun.
Okay, great. Have fun, invest, and hopefully, obviously, make a lot of money. On that note, thank you very much, Akshay Bhargava, for joining me.